In this video, we look at the top 5 mistakes people do when investing, and these mistakes can at the very least reduce their growth potential, and at the very worst, they make investors lose all their money. So hopefully by the end of this video, you won't be making any of them. One of the big mistakes people do when starting to invest is not understanding their financial situation and goals. It is vital for investors to understand how much they can really afford to invest, because remember, investments carry risk. Understanding your financial situation also means understanding yourself as an investor. How much risk are you ready to take? How would you react if your portfolio lost half its value over a short period of time? Would you rather have a steady low growth rate or a volatile investment with greater potential? What's your investment target and how long are you planning to get there? These are some of the questions you will need to have answers for before embarking on your investment journey, because they determine your risk appetite, and this in turn determine what you invest in. If you don't fully understand your financial situation and goals, you may end up picking investments which are not suitable for you. The second mistake follows from the first and happens when you don't fully understand the risk of the product you're investing in. Even if you haven't made the first mistake and fully understand your financial goals and situation, you may still end up investing in the wrong products because of a lack of understanding of the associated risks. Investments carry different types of risk. For example, your investment may be too focused on one country, industry, company, asset type, and hence be exposed to political risk, currency risk, sector risk, individual risk, etc. Understanding the risks means you'll be able to diversify accordingly and build the right portfolio for you with a level of risk that you are comfortable taking. A third mistake is not understanding the cost of investing. Now, there are several costs associated with investing, the most common of which is trading commission, that is a charge for executing a trade. Some platforms have no commission dealing fees, but beware, as there may be other costs involved, such as management fees for funds and your account. Other fees may not be immediately obvious, such as the bid-offer spread and stamp duty if you're in the UK. Now, these fees stack up, which means in the long run, with the power of compounding, your loss in potential value becomes greater. In fact, it has been shown repeatedly that the low cost of a fund is actually one of the best predictors of success. The fourth mistake people do when investing is timing the market, to the point they're almost day trading. This is particularly true for beginners who mistakenly believe they can time the market perfectly by buying and selling at the right time. The reality is that market prices are unpredictable, and you're likely better off investing in the long run than trying to trade. These days, many people are trying to sell you training courses on how to become a successful trader, but have yet to see any evidence that you can consistently beat the market by day trading and over a long period of time. I think this just plays on the psychology of that the more active you are, the better the results. And that's true for many things like exercise, but that doesn't necessarily apply to day trading. This leads me to the last on the list of mistakes, being emotionally driven. A good investing practice is to make decisions based on rational analysis, not gut feelings, and not feelings of fear or greed. As mentioned previously, market prices will fluctuate, and that's when your resolve will be tested. If you're going to give in to fear, then you may make bad decisions, such as selling at the low points during a recession, which is transient. On the other hand, if you are driven by greed, you may fail to spot the signs of a bubble or fail to diversify properly to the risk level mentioned earlier. Therefore, it's important to keep a rational approach to investing and think long run. That's it for me. I hope you find this useful, and remember to like and subscribe if you did. As always, thank you for watching and see you next time.